Hello, Investment Putts back with you again. I'm not moving slowly on new videos, but I've definitely been doing a lot of thinking lately. So a lot of people on YouTube will tell you that if you just buy leaps or long-term anticipation securities, that you can simulate stock without actually owning stock. So a leap is simply a deep in the money call option that expires far in the future. So how deep is a question, and how far in the future is another question. But in this case, this option here is 5 months in the future and about $100 in the money. And this is an option on the SPY. So if you own 100 shares of stock, you have a plus 100 delta position. This particular leap has a delta of plus 94. So owning the leap is roughly equivalent to controlling 94 shares of SPY, but for a fraction of the cost. Specifically, you pay about $10,000 to control about $42,000 worth of SPY. That's a 4.2x leverage, which is great in times like this when the market just dumbly marches upward with very low volatility. But leverage cuts both ways, as we will find out eventually. So the poor man's covered call consists of buying a leap option and then selling covered calls against the leap to get cash flow and also to smooth out the ups and downs in the share price. So it's a hedge as well. So here's an actual poor man's covered call from my current portfolio. My leap is plus 74 delta, while my short call is minus 66 delta. This leaves a net delta exposure of plus 8, which is similar to controlling 8 shares worth about $3,600. So typically I sell short calls that are at the money or slightly out of the money, but in this case the share price has moved up, so the delta of the short call is more sensitive than the delta of the leap. So it was a 75 delta, or say 70 delta leap when I bought it. The delta of the leap went from 70 to 74, whereas the delta of the short call went from, say, minus 50 to minus 66. So here's an allocation spreadsheet for my Robinhood portfolio, which has currently got about $28,500 in it. I own 2 equity ETFs, SPY and IWM, the Russell 2000. I own TLT, which is a bond ETF, the gold ETF, and DBC, which is a diversified commodity ETF. I also own Robinhood shares, some cryptocurrency, and some cash. So this is ideally how I would divvy up my account if I was just buying shares. However, I'm going to use the poor man's covered call to achieve a net delta that gives me the desired exposure in each stock. So for instance, in order to have $11,000 in exposure to the SPY, I need a net delta of plus 25. So to accomplish that, I could buy a plus 75 delta leap, then I could sell at the money covered calls at minus 50 delta to achieve a net delta of plus 25. So here's the other half of my spreadsheet. Periodically, I will tabulate the delta of my leap and my short call for each position to compute the actual net delta exposure for that position. So then I calculate the amount of delta change needed to achieve the desired allocation. So for SPY, ideally I want to have $11,000 of exposure, which is plus 25 delta. So to do this right now, I only have a plus 9 delta. So to achieve the plus 25 delta, I could buy back the minus 66 short call. Then I could sell an at the money minus 50 delta covered call to achieve the net plus 25 delta exposure. So anyway, if I total up the actual dollar exposure for each security, I can compute the total leverage. So in this case, I have about $30,000 in exposure, which is only 105% of my $28,500 account. So this is a pretty conservatively managed portfolio. Here's the same spreadsheet for my other trading account, which is currently worth about $26,000. So the nominal exposure is a bit over $40,000, which is a 1.56x leverage factor. The leverage here is similar to trading on margin, but it's less risky than actual margin account. So with the poor man covered call, your leap can go to zero value, but it can't go below. So if there's a huge drawdown, you can get wiped out, but you're not going to end up owing additional money to cover the margin call. So here's the second portfolio's performance when I was carrying 2x or even more leverage. So you notice that the drawdowns are typically larger than the drawdowns in a SPY virtual account or a SPY bond mix. So this is nice. I like the poor man's covered call. You can easily kind of control the risk. You can control the risk for different stocks. If a certain stock has been weak and you think it's going to come back, you can have a higher delta exposure. If something has been going up and up and up and you think it's going to have a correction, you can lower your net delta exposure. So it's kind of a nice way of dynamically adjusting your net exposure to each stock. It was really an eye-opener for me. I knew I needed to hold cash in my account and not fully invest every dollar in leaps or in poor man's covered call, but this really highlighted that. You have to be really careful trading the poor man's covered call over a whole portfolio. If you just do it out of the box, most people out of the box will be buying 80 delta or 90 delta leaps, and they'll be selling like minus 30 delta covered calls against it. So that's leaving them with a plus 50 or plus 60 delta exposure. So that's a lot of exposure, and that's a lot of leverage if your cash is fully allocated. So anyway, hope you find that interesting. I certainly have, for managing my own accounts and really dialing back some of the exposure, understanding the exposure. But I'd really love to hear your feedback and comments in the comment section. So we'll see you in the next video. Thanks.